As a reminder, the codification includes standardized sections for both the initial as well as subsequent measurement of accounts. We've already considered different factors that play into the initial cost of inventory that goes on the books, and it's going to remain there until the inventory is sold. I think it goes without saying that companies that stay in business end up selling inventory at prices greater than what they paid for it. But even in anticipation of that gross profit from a sale, the underlying asset inventory is never going to be written up in value based on our expectations of the future. However, the subsequent measurement of inventory certainly comes into play when, for a variety of reasons, inventory is expected to sell for less than its cost. Inventory can be physically damaged in its handling, it can spoil or expire, it's subject to changes in trends or seasonality, its value can be impacted by the loss of a major customer, or other more general market forces. We can't go through all the different scenarios, but it's important to realize that situations can arise when not only do you not expect to sell inventory at a profit, it may not even be able to recover its historic cost. So, given these possibilities, companies are required to evaluate inventory at the end of each reporting period and record write-downs where appropriate. We'll do calculations and prepare journal entries later, but for now, I want you to remember that the relevant accounts involved in the write-down of inventory might be different based on the company's typical experience. Specifically, cost of goods sold will be debited if inventory write-downs are common for the company. Otherwise, we would recognize an impairment loss if the write-down is considered to be more of an unusual event. Now, I want to return to a measurement attribute that we talked about towards the beginning of the semester, namely net realizable value, which I'll sometimes refer to as NRV. NRV is defined as the estimated selling price of inventory less any relevant selling costs, which can include things like shipping costs or selling commissions. This measurement attribute is most visibly taught alongside inventory, though it can appear in other contexts as well. But going back to how this can relate to the subsequent measurement of inventory, if a company's products have been damaged or otherwise experience obsolescence, you would naturally expect that the NRV of those goods to have declined. And if that decrease in value has fallen below the original cost of those goods, that is a situation that warrants an inventory write-down. Specifically, companies must report the value of their inventory at the lower of cost or net realizable value. However, this rule, the LCNRV rule for inventory valuation, applies specifically to companies using the FIFO or average cost flow assumption. As a result of applying this test, companies can assess the value of inventory at the individual item level or for broader categories, even the entire inventory balance, and we'll practice each of those in time. Well, what about companies using an alternative cost flow assumption? For now, I'm going to keep things simplified and just say that if a company is using the LIFO cost flow assumption, they must report inventory at the lower of cost or market, which is a slightly different test. Market, as applied to the value of inventory, is defined as its replacement cost with two possible exceptions. First, it cannot be greater than net realizable value, which we refer to as the ceiling. Second, it cannot fall below net realizable value minus a normal profit, which is referred to as the floor. And these terms come straight from the codification. So put differently, if the replacement cost of inventory is between the ceiling and floor, it by default represents the market. But if the replacement cost ever rises above NRV or falls below NRV minus a profit, then those upper and lower bounds will become the value for the market. Now, this is technically correct language that comes straight from the codification, but I've found that students sometimes stumble over what each term means when solving problems, so I provide the following practical guidance. If I'm solving one of these problems, I just find all three of those numbers and find the middle one. That is the market. Then lastly, it's important to remember that determining market is just one step. After we've determined what market is, We then need to compare it to the historic cost to decide whether an inventory write-down is necessary. Inventory write-downs represent timely communication of bad news to financial statement users. I found that students often like these lower of cost or market rules because they are pretty darn formulaic. If you know what you're doing, you can feel incredibly confident with your answers to problems like these. That said, I just want to put out another reminder that the real world can get a lot more complex, with considerable judgment being needed to determine the estimated selling prices and other relevant market data.